We often hear about value investing as a timeless, almost sacred path to wealth. It's the promise whispered in hushed tones. Buy low, sell high, focus on intrinsic worth, and let the markets folly work in your favor. There's an undeniable allure to this narrative, a sense of stability and predictable returns in a world that often feels chaotic and unpredictable. It speaks to a deep desire for control, for a method that seems grounded in something more enduring than fleeting trends. But what if the popular narrative, the one often repeated without question, is obscuring a deeper truth? What if the folklore surrounding value investing is, in fact, a veil, preventing us from seeing the strategy with the clarity it deserves? Here, we don't just repeat the old stories. We promise to cut through the dogma, to peel back the layers of tradition, and to examine value investing not through the lens of anecdote or assertion, but with the sharp, unwavering scalpel of rigorous quantitative analysis. Benjamin Graham, the father of value investing, understood this intimately. He famously stated, "The investor's chief problem is never the market itself, but rather his own emotions and behavior." This video is built upon a profound insight. We aim to show how rigorous quantitative analysis can serve as the antidote to the emotional pitfalls that have long plagued even the most well-intentioned value strategies. Today, we embark on a journey to debunk the myths. We will systematically dismantle 7 common misconceptions that hinder true value. We will explore what the data actually says, what the numbers reveal when we look beyond the familiar tales and into the heart of financial reality. This is not about dismissing the wisdom of the past, but about refining it, purify it with the light of objective, measurable truth. What are these myths, and how do they shape our perception and our portfolios? Let's begin to uncover them. There's a persistent echo in financial circles, a narrative that whispers that value investing is, well, dead. The argument often goes that the future belongs solely to growth, to the companies promising explosive innovation and rapid expansion. We're told that the old ways, the focus on intrinsic worth and tangible assets, have been permanently eclipsed by the dynamism of the new economy. But when we strip away the sentiment and look at the data, a different picture emerges. Academic evidence, particularly from factor-based investing models like those pioneered by Foma and French, consistently shows value's resilience. It demonstrates not just survival, but cyclical outperformance. Think of value investing not as a static destination, but as a cyclical journey. It's like a seasoned hiker who knows the terrain intimately. Quantitative analysis, in this analogy, is our detailed map and compass. It helps us identify the value valleys where opportunities lie hidden, and the growth peaks that may be overvalued, all guided by objective data, not just intuition or popular opinion. The myth that value is dead often arises from succumbing to short-term market noise. It stems from conflating something that is simply cheap with something that is truly good or fundamentally sound. Rigorous quantitative screens are our filter. They go beyond superficial metrics like a low price-to-earnings ratio and delve into robust financial health indicators. By combining metrics such as price-to-book, enterprise value-to-EBITDA, and dividend yields with forward-looking analyzers, we can reveal the true potential of undervalued companies. This is where the actionable insight lies. How do we build a quantitative screening process to identify these genuinely undervalued companies? It's about moving beyond the headline numbers to assess deeper financial strength, sustainable competitive advantages, and sound management. The quantitative analyst, in this pursuit, acts as a financial archaeologist. They sift through layers of market sentiment and speculation, carefully unearthing the buried treasures of true value. This process proves that dead is often just a temporary state of market mispricing, waiting to be discovered by those who look with a quantitative eye. A pervasive image of the value investor is that of someone rummaging through the bargain bin, picking up distressed companies with fundamentally weak businesses simply because they appear cheap. This notion, however, misses a crucial distinction that rigorous quantitative analysis illuminates: the profound difference between simply cheap and quality at a reasonable price. This is the core of the GARP, or growth at a reasonable price, philosophy, where quantitative metrics are paramount. Consider the analogy of fine wine. A cheap bottle might indeed be a bargain bin find, but its value is questionable and likely fleeting. A truly valuable wine, however, is appreciated for its age complexity, its depth, and its enduring quality, even if it commands a premium price. Similarly, quantitative metrics such as return on invested capital (ROIC), the strength of a company's competitive moat, and its debt-to-equity ratio reveal this inherent quality, allowing us to distinguish true value from mere cheapness. Traditional valuation multiples alone can be misleading. They can point to a stock that is cheap for a reason, because the business itself is deteriorating. Quantitative analysis, therefore, must incorporate a broader set of metrics. By examining return on invested capital, free cash flow generation, and profitability trends, we can build a more robust picture. This ensures we are acquiring quality businesses that the market has temporarily overlooked, rather than simply buying into a declining enterprise. The actionable insight here is to implement quantitative quantitative checks for profitability, capital efficiency, and balance sheet strength. These checks should be performed alongside traditional valuation multiples. This dual approach allows us to identify quality value opportunities, companies that are fundamentally sound and trading at attractive valuations. Ultimately, the quantitative value investor is not merely a bargain hunter. They are more akin to a curator, using the precise tools of data analysis to identify enduring quality. They spot companies whose intrinsic worth has been temporarily undervalued by the market, much like a connoisseur recognizing a masterpiece at an estate sale. Confident in its lasting appeal and inherent value, the notion that value investing is inherently slow and boring, a passive strategy of simply buying and holding with minimal engagement, is a significant misconception. This perception often leads to the belief that wealth accumulation through value is a glacial process. However, quantitative evidence paints a different picture, highlighting the potent power of compounding and the active, data-driven role that strategic rebalancing plays. Think of compounding as a snowball rolling downhill. The initial push, your initial investment, and the slope, your rate of return, are undeniably crucial, but quantitative analysis ensures that the snowball is constructed from solid, well-chosen material. It helps us to minimize any potential melt-off due to poor underlying assets and to maximize its growth by consistently selecting the most robust opportunities. This isn't passive, it's about building a powerful engine for wealth. While patience is indeed a virtue in value investing, describing it as boring is a misnomer. Quantitative analysis empowers active portfolio management. It provides objective data points to identify when a company's fundamental thesis has changed, when a security is no longer undervalued according to our metrics, or when entirely new, more compelling opportunities emerge. This is not about chasing fads, but about responding intelligently to evolving financial realities. This leads to an actionable insight. Utilizing quantitative triggers for portfolio review and rebalancing is essential. These triggers ensure that the original value thesis for an investment remains intact. They also allow for the effective reallocation of capital as market conditions shift and company valuations evolve. It's a dynamic process, guided by data. The quantitative value investor, therefore, is not simply waiting. They are more like a patient gardener, diligently nurturing growth through meticulous analysis and strategic pruning. They understand that sustainable wealth is cultivated, not stumbled upon, and they achieve this with the precision and clarity that only data can provide. This approach proves that value investing, when powered by quantitative rigor, is both dynamic and deeply rewarding. The idea that value investing is solely about crunching numbers, that it relies exclusively on the cold, hard facts presented in financial statements, is another common oversimplification. While financial statements are undeniably a critical foundation, rigorous quantitative analysis doesn't stop there. It possesses the remarkable ability to integrate qualitative data and behavioral insights, creating a far more complete and nuanced understanding of a company's true worth. Consider the analogy of a skilled physician. They don't just rely on vital signs and lab results, the quantitative data. They also observe the patient's demeanor, listen intently to their reported symptoms, and assess their overall well-being, the qualitative aspects. Similarly, a sophisticated quantitative value investor uses financial statements as a starting point, but then integrates information about management quality, the strength of competitive moats, and prevailing market sentiment. This holistic approach leads to a more robust valuation. Financial statements, while essential, are not the entire story. They are the skeleton, providing structure. But to truly understand a company, we need to add the flesh and personality. Quantitative analysis can incorporate tools like sentiment analysis derived from news and social media, detailed examination of management commentary through linguistic pattern recognition, and assessments of the competitive landscape using frameworks like Porter's 5 Forces. These methods allow us to quantify otherwise qualitative factors, building a richer, more predictive valuation model. The actionable insight here involves learning techniques to quantify these qualitative factors. This might mean developing scoring systems for management competence, rigorously assessing competitive advantages, and then integrating these scores into a broader quantitative valuation model. This approach moves beyond simple ratios to capture the multidimensional reality of a business. Ultimately, the quantitative value investor constructs a multidimensional portrait of a company. The financial statements provide the essential skeletal structure, but it is the carefully analyzed qualitative data that adds the flesh and personality. All of this is viewed and interpreted through the objective, unwavering lens of data, revealing a more accurate picture of enduring value, a seductive yet flawed assumption often accompanies the idea of quantitative value investing, that a purely rational, data-driven approach somehow renders investors immune to human emotional pitfalls. The thought is that if we let the numbers lead, our biases will simply vanish. Yet, the reality is far more nuanced. Even the the most sophisticated data analysis can be subtly, or not so subtly, influenced by our inherent biases. Imagine a highly sophisticated navigation system, our quantitative analysis tool. It can chart the most efficient route, predict traffic, and offer precise directions. However, this system can still be steered off course by the driver, the investor, who ignores its warnings due to impatience, overconfidence, or a stubborn adherence to a preconceived notion. Understanding these driver biases, these deeply ingrained human tendencies, is absolutely crucial for any quantitative investor. Behavioral finance provides the essential framework for understanding how these biases can creep into even the most rigorous quantitative analysis. Confirmation bias, for instance, can lead an investor to cherry-pick data points that support a pre-existing value belief while ignoring contradictory evidence. Anchoring bias might cause an investor to remain fixated on an initial purchase price, even when new data suggests it's no longer a reasonable valuation. Loss aversion can prevent timely exits from losing positions. The actionable insight here lies in actively working to neutralize these biases. This involves implementing techniques like pre-mortem analyses, where we imagine an investment has failed and work backward to identify the potential causes. It means creating quantitative checklists that specifically aim to counter common biases, for example, requiring a certain threshold of contradictory evidence before abandoning a conviction, or setting strict data-driven stop-loss parameters that are adhered to, regardless of emotional reluctance. Ultimately, the quantitative value investor must strive to be like a scientist in a meticulously controlled laboratory. They must rigorously account for all variables and actively acknowledge potential contamination, the subtle, pervasive influence of bias. Only by ensuring the integrity of their experiment, the investment decision-making process, can they truly harness the power of quantitative analysis and achieve sustainable, rational success. We've journeyed through the landscape of value investing, systematically dismantling pervasive myths that have long clouded its true potential. We've replaced conjecture with the clarity of quantitative evidence, showing that value investing is not dead, not confined to the bargain bin, nor inherently slow or immune to our own human biases. It is, when augmented by rigorous quantitative analysis, a far more resilient, adaptable, and ultimately a more powerful strategy for sustainable wealth creation. The core takeaway is profound. Value investing, at its heart, is about finding opportunities where the market price does not reflect the underlying intrinsic worth, but the asterisk of identifying that worth has evolved. Quantitative analysis provides the modern tools to refine this process. It allows us to move beyond intuition and anecdote to a place of data-driven discernment. This evolution mirrors the journey of investing giants themselves. Warren Buffett, a devoted student of Benjamin Graham, eventually evolved his approach, famously stating, "I was a Graham disciple for 20 years. Then I met Charlie Munger and realized that it was far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Quantitative analysis is the bridge that helps us define wonderful and fair with objective data. It allows us to identify companies with enduring quality, strong competitive moats, and sound financial health, trading at prices that are genuinely attractive relative to their true, measurable worth. The future of value investing, therefore, is not about adhering to rigid dogma, but about embracing data-driven discernment. It's about blending the timeless principles of value with the sophisticated analytical tools available today. It's about asking not just is this cheap, but why is it cheap, and what does the data tell us about its future prospects? We encourage you to empower yourself with this data. Apply these quantitative lenses to your own investment decisions. Move beyond blind faith and cultivate informed conviction. By doing so, you can truly unlock the enduring power of value investing in today's complex markets. Subscribe for more insights that cut through the noise and reveal the quantitative truths behind wealth creation.